Hi, in this video, we'll talk about decentralized finance. Our content is what is DeFi, DeFi protocols, DeFi vs TradFi, applications of DeFi, and we'll see the applications decentralized exchanges, lending and borrowing, stablecoins, synthetic assets, staking, and insurance. So let us start with the definition of DeFi. Decentralized finance, or aka DeFi, is a new financial system that enables the creation of decentralized and trustless financial products and services. And let us see how it works. DeFi is built on blockchain technology, smart contracts, and tokenization. Blockchain technology provides the infrastructure for the creation of tokens, access to services, and participation in governance in DeFi applications. Smart contracts, on the other hand, enable automatic execution of rules and conditions without intermediaries, and this enables DeFi applications. Tokenization is the process of creating digital assets or tokens that can be used in DeFi applications. So in this regard, blockchain technology, smart contracts, and tokenization are all related in that they are all key components of decentralized systems, and they work together to enable secure and efficient transactions. Okay, now when we look at it, blockchain is the foundation of the system. It provides a decentralized ledger that records all transactions on the network. Smart contracts, on the other hand, which are self-executing contracts with the terms of the agreement written directly into lines of code, and they are built on top of the blockchain technology, and they provide a way to enforce the rules of the contract. In the fourth and fifth section of this course, we'll create our own smart contracts and we'll be able to understand everything in a better way. Tokenization is the process of representing real-world assets as digital tokens on the blockchain, and these tokens can be used to represent ownership of the assets or give access to a service, and can be traded securely and efficiently on the blockchain. Together, blockchain technology, smart contracts, and tokenization enable the creation of decentralized systems that can facilitate secure and efficient transactions of assets without the need for intermediaries. Alright? So let us see DeFi protocols. DeFi protocols are a set of guidelines that dictate the functioning and interaction of different DeFi applications. For example, automated market maker protocol is used by many decentralized exchanges, a type of DeFi applications, including PancakeSwap. So let us see some of the features of DeFi protocols. Openness. DeFi protocols are open source, and the working mechanism of the protocol can be reviewed by anyone. Accessibility. DeFi protocols are available regardless of time and place. Censorship resistance. Transactions are resistant to censorship as they are not administered by central authorities. Transparency. All actions performed by the application can be monitored by all users. Decentralization. DeFi protocols are built on blockchain technology so that they are not controlled by any single entity. Automation. Transactions are executed by smart contracts, eliminating the need for intermediaries and reducing commission costs. Let us compare DeFi and TradFi. In a decentralized finance system, for example, a user wants to send money through the blockchain. In this regard, the blockchain transfers money between accounts without a trusted third party taking custody, for example, like banks. And the other user receives money to their public address. In a traditional database, on the other hand, when someone wants to send money through their bank, the bank takes the full custody of the funds and transfer money between them, and the other peer can receive the money in their own bank. When we compare them, transaction fees are generally lower than TradFi in DeFi. In TradFi, there are high commissions in money transfer transactions, especially for international transactions. DeFi is available to use 24/7 at any time. Traditional finance, on the other hand, is open to trade only certain hours and days. There is no need for permission or authorization to participate in DeFi services. But for TradFi services, it typically requires permission and authorization from an institution to participate. Since DeFi is built on the blockchain, all the transactions are transparent. But when it comes to traditional finance, transactions executed and seen by only centralized financial institutions. So let us see applications of DeFi. Its applications refer to financial services developed using blockchain technology. These services encompass many of the services that the traditional financial system can provide. For example, decentralized exchanges, lending and borrowing, stablecoin, synthetic assets, staking, and insurance. So let us understand every single one of them. Decentralized exchanges. Decentralized exchanges are platforms that allow users to trade cryptocurrencies or digital assets in a decentralized and trustless manner. By allowing peer-to-peer trading, decentralized exchanges eliminate the need for intermediaries. Users retain full control over their assets and can track their transactions real-time. In this regard, let us see the full process here. A person creates a new transaction order, and this transaction order is signed by their private key. Then this transaction order is sent to blockchain. Then the taker adds their signature to the order, and the smart contract in the decentralized exchange validates the order. And we can now call that, okay, the fund is transferred. Lending and borrowing. In DeFi lending and borrowing, users interact directly with each other to lend or borrow without the need for intermediaries. By utilizing blockchain technology, DeFi transactions offer increased speed and reduced commission fees. In this regard, we have a borrower, DeFi lending platform, and lender. And a borrower deposits crypto assets as collateral. Then the lender deposits fiat currency. Borrower obtains crypto loans. Then they also repay the loan with interest. Then the lender receives funds back with interest. And lastly, the borrower receives collateral back after the repayment. Let us see stablecoin. Stablecoins are a type of cryptocurrency that are designed to maintain a stable value, often pegged to a specific fiat currency such as the US dollar or euro. Stablecoins are digital assets that aim to combine the benefits of cryptocurrency with stability, avoiding the volatility that makes traditional cryptocurrencies difficult to use for transactions or as a store of value. Stablecoins offer faster and cheaper transactions than fiat money due to their blockchain-based technology that allows for quick processing and low fees. They can be used in any country and transferred globally with less friction and costs compared to traditional fiat money transfer. Synthetic assets. Synthetic assets are digital assets that are created through smart contracts and mimic traditional assets such as stocks, bonds, and commodities. They are created by using a collection of underlying assets as collateral. This collateral is then used to generate a new digital token that reflects the value of underlying assets. In this regard, synthetic assets can allow more efficient and flexible trading and investing because they can be traded 24/7 and at lower costs compared to traditional trading methods. They can be used to track the value of an underlying asset, such as a stock or commodity, allowing individuals to invest in those assets without actually buying them. Let us see staking. Staking in the context of DeFi is the process of committing one's digital assets to DeFi platform for a period of time. During this time, the assets are locked and cannot be withdrawn. This liquidity helps the platform maintain the overall stability and functionality. In this regard, let us see the process together. The user chooses a DeFi platform. Then the user stakes their assets. Then the user chooses a validator of the DeFi platform to provide the stake. Then they are rewarded with a proportionate return in recognition of the contributions, which can serve as a passive income. Let us also understand applications of DeFi based on insurance. DeFi insurance refers to the use of smart contracts to create decentralized insurance protocols. These protocols enable the creation of insurance pools and the automatic payment of claims, which may take insurance more accessible and transparent. In this regard, let us understand everything here one by one. An insured person is an individual or organization that purchases an insurance in a traditional insurance system. An agent is a representative of an insurance company who sells insurance policies to customers and provides assistance with claims. Coverage refers to the protection provided by an insurance policy, including the types of losses that are covered and the maximum amount of money that will be paid out in the event of the claim. We also have this risk and claim assessment, which is the process of evaluating the likelihood of a claim being made on an insurance policy. And here an insurance carrier is the company that provides the insurance policy, and they are responsible for paying out the claims. And of course, we also need a system that can regulate this insurance carrier, which is a compliance or a governance. They refer to the process of ensuring that financial institutions and their products and services comply with laws, regulations, and industry standards. Okay, this is traditional insurance, but when it comes to decentralized finance, we have something different. Here, an insured refers to an individual or organization that holds a position in a decentralized finance protocol, such as a long position in a decentralized lending platform. Coverage refers to the protection provided by an insurance policy, in this case against loss of funds due to the smart contract bugs, hacking, or other types of risks. Premiums are the fees paid by the insured person for the coverage provided by the insurance policy. Here, protocol governance refers to the process of managing and making decisions about the protocol, typically through a decentralized autonomous organization, also known as DAO, or other decentralized governance mechanism. And we have also seen smart contracts. They refer to a self-executing contract with the terms of the agreement between the buyer and seller being directly written into lines of code. Smart contracts are used in DeFi insurance to manage the insurance products, claims, and payouts. We also have capital providers. They are entities that provide the funds needed to pay out insurance claims. In DeFi insurance, these can include individual investors, insurance companies, or any other financial institutions. In this regard, what is the difference between DeFi and TradFi? A DeFi, or decentralized finance, refers to a new financial ecosystem built on blockchain technology, and this enables the creation of decentralized financial applications that operate independently of traditional financial intermediaries. These applications are often built on smart contract platforms like BNB chain or Ethereum, and they can include things like decentralized lending, trading, and insurance. Traditional finance, on the other hand, refers to the financial system as it exists today, where financial intermediaries like banks and other institutions play a central role in managing and intermediating financial transactions. This includes things like saving accounts, loans, and insurance policies. The main difference between DeFi and TradFi is the degree of decentralization and autonomy that is present in the two systems. DeFi is built on decentralized infrastructure. Okay, and this enables trustless peer-to-peer transactions and new forms of financial intermediation. In contrast, traditional finance relies on centralized intermediaries to manage and facilitate transactions, which can be more costly and less transparent. So that's gonna do it for this video. I will see you in the next one.